Is risk management important for banks? Well, let's find out. Hi everyone, welcome back to our channel. In today's video, we are going to discuss about risk management, particularly in banks. So, risk management is the process of identifying, assessing, and controlling the threats that can adversely affect an organization's ability to achieve its objectives. It is the responsibility of every bank to safeguard its assets from any kind of losses. For example, credit risk, market risk, operational risk, compliance risk, etc. Banks must identify all these risks and their potential impact on the financial health of the bank. After assessing the risks, the bank develops a plan to mitigate the risks that have been identified. This involves collecting and analyzing data on the risks and comparing it with the bank's risk appetite. If the bank's risk appetite is exceeded, then the risk mitigation plan must be reviewed and updated as necessary. This may include putting in place policies and procedures, developing contingency plans, etc. These reports should be submitted to the board of directors and other stakeholders at regular intervals. Banks play a crucial role in the economy by providing financial services to individuals and businesses. However, banks are also highly regulated industries due to the systemic importance of the banking sector. Banks are required to maintain a certain level of capital and liquidity to ensure that they can continue to operate even in times of financial stress. By implementing effective risk management practices, banks can mitigate these risks and protect their financial stability. By implementing a robust risk management framework, banks can ensure that they are complying with all applicable laws and regulations and avoid costly penalties and fines. By identifying and managing risks, banks can develop strategies to capitalize on new opportunities and drive business growth. Additionally, banks are expected to comply with a number of laws and regulations designed to protect consumers and maintain the stability of the financial system. The report should discuss the bank's risk profile, the effectiveness of the risk management process, and any changes that have occurred during the reporting period. If yes, then please consider subscribing to our channel. Also, if you want us to cover any specific topic on risk management, then please comment down below. Thank you, and see you in the next video. Risk management is a critical function in any bank, and it helps the bank to achieve its objective of safeguarding its assets from all types of losses. Risk management helps in identifying, assessing, and controlling the risks that can adversely affect the bank's ability to achieve its objectives. The risk management process involves 5 steps: risk identification, risk assessment, risk mitigation, risk monitoring, and risk reporting. Risk management is important for banks to protect their reputation, ensure regulatory compliance, optimize capital allocation, manage financial risks, and support business growth. For example, to mitigate credit risk, the bank may decide to diversify its loan portfolio or to require collateral from borrowers. In today's highly interconnected world, a single risk event can quickly spread and damage the bank's reputation. By effectively managing risks, banks can build trust with their customers and stakeholders and protect their reputation in the long run. Risk management is a systematic way of dealing with the uncertainty of future events. The ultimate goal of risk management is to increase the likelihood that the bank's objectives will be achieved by identifying potential events that may prevent the bank from achieving its objectives and taking actions to minimize the likelihood or impact of such events. By understanding and managing the risks involved in each decision, banks can optimize their capital allocation and maximize their profitability. Risk management involves the formulation of a plan of action to deal with the risk and the periodic evaluation of the risk and the effectiveness of the plan of action. So if you want to know more about risk management in banks, then this video is for you. So without any further delay, let's get started. First of all, let's understand what is risk management. Once all the risks have been identified, the next step is to assess the likelihood and impact of each risk. This can be done by using various tools and techniques such as risk matrices, sensitivity analysis, etc. Based on the assessment, the risks are categorized into different levels of priority. So now, let's understand the 5 steps involved in the risk management process in a bank. Step 1. Risk identification. This is the first and foremost step in risk management, where all the possible risks that can affect the bank's operations are identified. Step 2. Risk assessment. Step 3. Risk mitigation. Step 4. Risk monitoring. The bank must continuously monitor the risks and the effectiveness of the risk mitigation plan. Step 5. Risk reporting. The bank must prepare reports on the risks and the risk management process. Let's understand why risk management is important for banks. So now, let's discuss the importance of risk management in banks. Number 1. To protect the bank's reputation. Number 2. To ensure compliance with regulations. As mentioned earlier, banks are highly regulated industries. Number 3. To optimize capital allocation. Banks have limited resources and must carefully allocate their capital to different business units and activities. Number 4. To manage financial risks. Banks face a variety of financial risks, including credit risk, market risk, and liquidity risk. Number 5. To support business growth. Risk management is not just about mitigating negative events, but also about supporting the bank's strategic objectives. So, these are the few points which explain the importance of risk management in banks. Lastly, let's summarize everything. So this was all about risk management in banks. I hope you have learned something new here.